What is the rate of trigger? Your trigger rate is the interest rate at which your regular payment is insufficient to cover all of the interest that has accrued since your last payment. As inflation continues to drive up prices, the Bank of Canada has increased interest rates in an effort to regain control. The prime rate of the majority of the banks have more than quadrupled this year, from 2.45% all the way to 5.5%. Now, this substantial increase has raised public concern regarding the trigger rate for mortgage borrowers. So nothing will change for you if you have a fixed rate mortgage until it's time to renew. However, if you have a variable rate mortgage, these rate increases have an immediate and direct impact, and you may be at risk at exceeding your trigger rate. However, not all variable rate mortgage holders must be concerned about trigger rates. What is the rate of trigger? Your trigger rate is the interest rate at which your regular payment is insufficient to cover all of the interest that has accrued since your last payment. So in other words, your whole mortgage payment goes towards interest and none of it towards the principal. This is the first of two possible triggers. When you reach your trigger rate, what is triggered is a rise in your outstanding balance. Due to the fact that your regular payment is insufficient to meet the cost of borrowing, the entire payment is allocated to its interest, and your remaining balance is referred to as deferred interest and added to your debt to be paid at a later date. Now, when you hit your mortgage's trigger rate, you stop making mortgage payments and begin to borrow more. This is referred to by experts as negative amortization. Now, what happens when my trigger rate is reached? Although no action is required when you reach your trigger rate, your lender or mortgage broker will likely call to inform you that your payments are no longer sufficient to pay off your mortgage. They will describe your alternatives and assist you in making an informed choice of how to proceed. However, just because you can continue making the same monthly payment as before does not mean you should. With each passing month, you will owe more and more money on your mortgage. Your rising balance will need a rising interest payment, exasperating the problem over time. Now, whenever possible, increase your monthly mortgage payment well before you reach your trigger rate. Otherwise, you run the risk of reaching a level that is far worse, your trigger point. So what is the trigger point? Your trigger point is the time at which you can no longer carry on with the same monthly mortgage payment that you've been making. The trigger point is not defined by a single overarching rule. Your mortgage provider will instead specify a specific trigger point. For example, a common trigger point occurs when the total outstanding on your mortgage exceeds the amount you initially borrowed. For instance, if you obtained a variable rate mortgage for $500,000 and you hit your trigger rate after paying down the debt to $490,000, the unpaid interest would now be applied back to your balance. You would hit the trigger point when your account balance reaches the $500,000 mark. Your trigger point could also be expressed as a percentage of the value of your property. For instance, you may reach a trigger point when your mortgage balance exceeds the appraised worth of your home by 100%. What happens when I hit my personal threshold? When you reach your trigger point, you will be required to begin paying off your balance. The lender will contact you to explain the choices and provide a time frame for correcting the issue. Your choices may include at least one of the following. So in order to get back on track, the simplest solution, although not necessarily the easiest to do, is to increase your monthly payments. The standards vary by lender, by banks, but your minimum payment must at least cover your interest expense and provide enough for some principal reduction. You may be necessary to adjust your payment in order to return to the original amortization schedule. Utilize a mortgage payment calculator to assess the potential costs. If you have cash laying around, you can make a lump sum payment towards reducing the balance of your mortgage. This is a one-time payment. It will bring you below your trigger point, but only temporarily if you do not increase your payments. Convert to a mortgage with a fixed rate. The majority of lenders permit consumers to move from variable to a fixed rate at any time. Fixed mortgage rates are often higher than variable rate mortgages, but they are guaranteed to remain constant for up to 5 years. This modification will almost certainly increase your monthly payments, but it will help you prevent additional surprises for the balance of your term. In addition to increasing your regular payments, you may be able to extend your amortization duration to maintain reasonable monthly payments. So remember that the longer you take to pay off your mortgage, the more interest you will ultimately pay to the bank. Extending a $100,000 mortgage from 5 years to 10 years at 4.25% incurs additional interest of approximately $11,000. Refinancing may incur penalties, and the standard penalties for breaching a variable rate mortgage is 3 months of interest and will most likely require the assistance of a real estate lawyer. Hope this helps. Who you work with matters.